Hello, everybody, and welcome to today's event, Financing a Just Transition for Emerging Markets. I'm Sonia Gibbs, Managing Director, Head of Sustainable Finance here at the IIF. Thank you for joining us. So today's event is the first in our series of COP talks that we've organized alongside COP27 in Sharm el-Sheikh in Egypt. This major global climate conference held from November 6th to the 18th will see a lot of participation from private sector financial firms, so building on the climate commitments made at COP26 in Glasgow. And of course, the financial sector is vital in the international push to achieve a net zero global economy and to support broader sustainable development goals, hence the focus on just transition. So our COP Talk series will cover some of the toughest but the most important questions facing our industry. Today's topic, Financing a Just Transition for Emerging Markets, really highlights the challenges in shifting the emerging markets' energy mix more toward renewables, improving energy efficiency, along with other mitigation and adaptation strategies. So to get us started, I'm delighted to welcome Jose Viñals, who will join us for a fireside chat here. Jose is Group Chairman of Standard Chartered and the Chairman of Standard Chartered Bank, a board member of the IIF, and has a very distinguished career with the Bank of Spain and the IMF. So welcome, Jose. It's wonderful to see you.
Thank you very much. Great to be here.
And this is our first COP Talk series of this year, and maybe we could start with some scene setting. So really challenging juncture for emerging markets, rising rates, strong US dollar, inflation, and at the same time, the need for climate finance, both mitigation and adaptation, has never been more acute, and it's a tough time for international coordination too. So how do you see this landscape evolving?
Well, as you said, Sonia, it's a difficult environment because emerging markets are facing two types of challenges, both of them extremely important. One are the macro financial challenges coming from the juxtaposition of a number of crises, what has been termed a poly crisis. And at the same time, they have to deal with long-term issues, which are related to the need to achieve a transition to net zero, and to do this in terms of what we all call a just transition, which is making sure that the emerging markets achieve net zero in a way which is consistent with their economic and social development objectives. So you need to think of the transition to net zero within the more general context of transitioning towards the sustainable development goals. And what we know is that on both sides of the challenge, both the macro financial challenge in terms of capital outflows, depreciating currencies, problems with their external debt, slowing growth, etc. They had to cope with these other longer-term challenges, and both of them need financing in order to, to make things move forward, and that's a challenge. Just thinking of the sustainability challenge, the net zero challenge. Research that we have conducted at Standard Chartered internally shows that emerging markets will need $95 trillion in order to achieve net zero by 2060. And this 2050, 2060, and just to give you an idea of the order of magnitude, this is about the size of global GDP. And if we think of the just transition, we'll go above that, because in order to achieve the sustainable development goals, we are thinking that emerging markets will need about 1.5 times what I just mentioned a moment ago. So we're talking about big financial challenges. And clearly, financial markets, in terms of their macro financial difficulties, need to maintain market access or restore market access as soon as possible, those which have lost it. But they also had to bring in the capital flows internationally so as to finance their transitions to net zero. And that's something that means that international capital needs to be there. And the public sector can do things, and we already know about the commitment of the 100 billion a year sort of capital inflows into emerging markets by the official sector, but that would not move the dial. We need the private sector to scale up, and this is something which is badly needed. The money is there, and we know that there are initiatives like G funds which have committed the sort of efforts of many financial companies to sort of do more with their assets and move them into the field of net zero transitions in emerging markets. But I think that we need to walk the talk in addition to talking the talk, walk the talk, and that is something which will require further effort to make sure that financing arrives at speed, but also at scale, because emerging markets don't have the amount of financing which is needed, and that money needs to come in internationally. So we need to think of what are the conditions that need to be put in place for that capital flows to come into emerging markets with the speed and the scale which is required.
No, exactly. And as you say, I mean, in order to attract private capital, you need the right kind of investment environment, a hospitable investment environment, things like better debt transparency, fiscal transparency, all the things that give investors confidence, especially if you're an ESG investor. So maybe you could focus on some of the debt-related challenges facing emerging markets. We've got a lot of problems after a big decade of debt buildup.
Yeah, indeed, this is a most important issue for emerging markets. This is something which is not something which is just due to COVID or the war, although both of them have aggravated the situation of emerging markets. There were pre-existing problems coming from the accumulation of external debt in particular, which went along paths which were, either unsustainable or at risk of being unsustainable. But of course, one needs to take a differentiated view, because not all emerging markets are created equal. And I would say that in terms of challenges to that sustainability, it is mainly the low-income countries and the frontier markets which are challenged. Many of them have already lost market access. And as we know, about 60% of those countries either have already debt crisis or are at risk of entering into a crisis. So this is something that requires action. Also, some middle-income countries have gotten into trouble, like Sri Lanka, and there may be others that follow. But fortunately, this is something which is not extending to the universe of emerging markets, because there are many with strong fundamentals, there are many which retain market access, and many who can handle issues in a much better situation. But for those who are challenged and which would need to go through a process of addressing their debt distress, there are some elements out there, and I think that the Common Framework Agreement by the G20 is an important tool, but we need to make that much more effective in dealing with situations. And of course, we all know that it's very important to have the full participation and full transparency on the part of all creditors. We know that there need to be a proactive approach towards debt restructuring rather than too little, too late, which only gets you into a bigger problem. And therefore, there are a number of improvements that would continue to be made to the international debt architecture. And you mentioned transparency, and I want to emphasize how critical that is. And of course, the initiatives that the IIF has taken with the OECD are very important in this respect, but we need transparency also on the part of all official creditors, because if we look at the external debt of the low-income countries, which are in a difficult situation, the majority of that debt, about 80%, is held by the official sector, which means that this is where the heavy lifting needs to come from. And if we add to that the fact that when we had the private sector involved in recent times, those restructurings have happened much faster than with restructurings where the public sector is involved, the official sector, then the thing is for more speed on the official sector side. And this is something that, again, would benefit tremendously from an enhancement of transparency. So I'm optimistic in the sense that the whole emerging market class, or the emerging market class as a whole, is going to be okay. But there are going to be issues specifically in low-income countries, in some middle income countries. And although those would not be globally systemic, it would be a big problem for those economies. And we need to address that, and address that not only that helps them overcome their debt distress, but also reassures that these countries can regain market access, because they would need the continuation of capital flows which are required both to grow and develop and to bring in the sustainable finance which is so necessary in those markets.
No, absolutely. And as you say, you know, the treatment of private creditors, the incentivizing of private flows really means that the environment needs to be fair and equitable in debt restructuring, greater transparency, and so on. So these are all critical efforts, and our principles for stable capital flows and fair debt restructuring too. And you're a trustee, of course, of these principles are very, very relevant in this context. But maybe can we turn to broader efforts to mobilize private capital? There's an awful lot of those, right? You mentioned GFANZ, there's the Global Investors for Sustainable Development, there's efforts to scale up blended finance, you know, so mixing concessional and private finance. So how do we best do this, you know, de-risk these flows, incentivize the private sector?
Well, I think that as you suggested, we need to come at it from all different points of view, and we need international cooperation. We need international cooperation among the private sector players. We need international cooperation between the public sector donors and the private sector. And I think that sort of international partnership is going to be critical. And we are already seeing a number of instances where that cooperation is materializing on the part of the private sector. And you mentioned GFANZ, you mentioned the United Nations Alliance of Global Investors for Sustainable Development, GISD. So there are a number of initiatives out there which I think are extremely important. But if we, you know, go back to the situation of specific emerging markets and the need to bring in international capital flows at pace and speed, then the question to ask is, if there is a lot of money available, and we know that there are, you know, hundreds of trillions of money available, why is the money not moving? And the basic reason is because of the risk issues which are involved in these international capital flows. For the private sector to move their capital around to invest, they of course need to, in addition to philanthropic or sort of impact investment, there needs to be an adequate risk-adjusted return prospect in order for the sort of capital that is needed to be unleashed at scale. And that means that the receiving countries, the emerging markets, need to do a number of things. First of all, they need to make sure that their institutional environment, their legal environment, their business environment is incentivizing the international capital flows coming into the country, not exiting the country. So that's extremely important, institutional quality. The second has to do with having a pipeline of sustainable projects, which could be net zero or other dimensions of sustainability. So that is something where emerging markets need to work together with the private sector in order to define a pipeline of sustainable projects, of net zero projects, and climate change related projects. And again, there are some initiatives in this respect, but they are not mature enough. But even if you have a pipeline of sustainable projects, you need to make sure that those are bankable and investable. And that means the risking. And the role of blended finance is extremely important. Standard Chartered, as an emerging markets fund, we do a lot of blended finance operations, working with national governments, with multilateral and regional development banks, in order to de-risk the projects and provide to investors the risk-adjusted return that they need to invest. But these things are happening in our case and other international banks or investors in a piecemeal manner. And we need to think of things that scale this out. And now we have, in addition to these sort of traditional transactions, we have initiatives on the part of some players in the industry, some asset managers, partnering with regional development banks to build platforms for investing sort of on sustainable projects, net zero related projects in a region. We now have the G20 sponsored just energy transition platforms, like the one in South Africa, now Indonesia and Vietnam, which are going to be very important and where the private sector should and will play a role. And then we need to think of global platforms and global platforms that allow for multiple multilateral development banks alongside with multiple institutional investors to invest in projects, sustainable projects, which are de-risked, and that can give you the sort of scale that you need. And for that, there are a number of things that need to happen. One is that multilateral development banks use their balance sheet in a more creative manner. And this is a process which is, it's not easy, but it's a process that has started following the the positions that some key countries, including the United States, have taken on this in recent months. And the other is developing these platforms. And, for example, at the UN's GISE, we are working on the development of a platform that can provide the incentives or align incentives, both for the public sector and the private sector to move at scale here. So you need a combination of all those different efforts in order to move forward, because the amount to be financed, as we said, over the next decades is to reach net zero in emerging markets is like the size of global GDP, and unless there is a very conscious effort, it would not happen just by inertia. It will need dedicated efforts like the ones that are in place now through GFunds, through the GISD and other efforts. And the IIF has been a tremendous player in trying to move the needle in the direction which is needed. And I think that's something that is very, very important to acknowledge.
It's going to keep us all going for decades, this scaling of these private flows and de-risking, as you say. And Jose, you've done a tremendous job setting the scene for us here, and also in kind of showing how just transition, is part of what you're doing at Standard Chartered across the business model. So I wish we could continue the conversation for another hour, but we know you've got a busy schedule, and I just want to thank you for sharing your thoughts with us today and getting us started on our discussion.
Yes, before we go, just one very quick thought on voluntary capital markets, which I forgot at the previous point. Again, that's an area where the IIF has really been fantastic in pushing for it from the very beginning. But the linkages between voluntary carbon markets as a complementary solution to the reduction of emissions, the ability to generate nature-based financing, and the fact that 90% of those sit with emerging markets, that's a tremendous source also of additional capital for emerging markets to finance a just transition. So I didn't want to leave the call without mentioning that. But thanks very much for having me here today, and I wish you a wonderful conversation in the panel.
Thank you so much, and thank you for pointing out the really critical role of voluntary carbon markets. I think we'll continue that discussion in the panel. So thank you so much, Jose.
Thank you. Bye-bye.
Okay, well, at this time, we can turn to our panel discussion. So let me go ahead and introduce our terrific panelists here today. And I'll start with Wendy Dobson, who is Chief Sustainability Officer for Standard Bank, and Amit Puri, who is Global Head of Sustainable Finance for Standard Chartered, and Nick Robbins, who needs very little introduction, a Professor in Practice for Sustainable Finance at the Grantham Research Institute of the London School of Economics, the LSE. Thanks, everybody, for joining this panel. And Nick, I want to start with you because you have a really, really interesting new report out on making transition plans just. You've got a lot in there on how global climate agreements and governments, private sector, everybody's made commitments, and now we're shifting to implementation. So, tell us about your key takeaways from the report.
Well, thanks very much, Sonia, for inviting me on this panel. It was really great to hear Jose setting out that scene. And I think he very helpfully laid out that the just transition obviously is a global priority, particularly between countries, and particularly ensuring that there is justice, particularly in the allocation of capital in emerging countries where the capital is needed most. But what we've done in this latest report, Making Transition Plans Just, is to bring that down from the sort of global level, from the country level, to the institutional level, because all the major financial institutions around the world on this call, banks, institutional investors, insurers, and others, have made commitments through institutions such as GFANZ to put in place net zero plans, credible net zero plans with short, medium term, long term targets. And I think the recognition we've seen is that these institutions on the call today recognize that as we're moving towards net zero, we need to be taking account of just transition principles. So what we've done in the report is, again, sort of show why the just transition is so important for the success of net zero, the right thing to do, necessary for building trust, but also really smart in terms of the human and social capital we need for successful net zero. And then looking through some of the sort of key features for financial institutions, taking account of the social risks of the transition. So, for example, workers and communities in high carbon sectors are not left behind. But I think then secondly, really thinking about some of the social opportunities, the job creation opportunities, development opportunities from the transition. And in all of this, making sure that the process is open and has meaningful dialogue and participation. So what we've done, we haven't reinvented any wheels. We've used the just transition principles and guidance which the ILO has come up with. We've based it on existing human rights and labour standards, and then used the GFANZ framework, the Glasgow Financial Alliance for Net Zero, about what a credible net zero plan looks like. And their latest framework came out, in fact, yesterday. And it's a very good methodical framework, looking at the foundations, the sort of overall commitments, looking at implementation in terms of, I know, banks, different customer groups, institutional investors, asset groups, asset classes, and so on, engagement with portfolio companies, engagement with governments, and then obviously governance from the board downwards and metrics. So what we've done in each of those 5 areas is show how just transition can be meaningfully incorporated, and really taking it down from the sort of imperative level to a much more granular action level. We've been really excited actually about the engagement we've had from financial institutions, from banks, from investors, Standard Chartered's colleagues contributed to this. And I think there's a real desire to translate the just transition into sort of practical action on the ground to make sure that we move forward on net zero, but make sure that net zero is contributing to development.
Well, as you say, you know, taking it down from 64,000 feet to a practical level, whether that's climate risk or disclosure, natural capital, just transition, all of these things are in very, very high demand. So kudos for getting all of that hard work out alongside all of the work that GFANZ has done. But Wendy, you know, Standard Bank, you guys have been real pioneers in committing to net zero, and a real leader in Africa. And you've been really focused on a just energy transition. So tell us what this means in a South African context, and maybe more broadly across the continent.
Thank you, Sonia. Thanks to the IIF for this platform. It's really great to be able to chat today. And just to say that the report published by the LSC that Nick has just referred to is really an excellent document. I really recommend people engage with it. Standard Bank is the largest bank in Africa. We operate in 20 African countries. And as you can see from my background, we are 160 years old this month. And for us, the concept of a just transition has been central to developing our own climate policy as a group. We operate on a continent where half of Africa's people don't have access to electricity. They're still using firewood and paraffin for cooking. It's a major constraint on human development, on economic development. And we can't ignore people's legitimate needs and desires for a better life. And what we're seeing is that we can expect that energy demand in Africa is going to increase rapidly as the population grows, as our economies grow over the next 10, 20 years. So what does that mean in the context of the need to decarbonize? And often when we work with our teams in different countries, so in Ghana, Mozambique, Angola, Nigeria, which are countries that are dependent on oil and gas for their revenue, their economies. Even within South Africa, we have regions that are economically dependent on coal and coal-fired power production. They often respond to us with a question: what transition? We don't want to go from the dark to the dark. We don't understand what this idea of a transition means when we don't even have access to reliable, affordable, or safe electricity. So the idea of a just transition then has to look at how do we take people along on this journey. So how do we have a people-centered transition and make sure that we don't leave people behind or that they feel excluded from this? And the more we think about this, is not something that is just an issue for emerging markets, for Africa. This is very much an issue that's front and center in Europe, in North America, as consumers face higher fuel prices and so on. You know, the realities of what the costs of a transition can be in the short term really start to hit home. So for us as a bank, making sure that we were able to put the need for energy security, addressing energy poverty, working with hard to abate sectors, looking at the role of hydrocarbons in Africa has been central to what we're trying to achieve, and trying to be realistic and pragmatic about the pace at which different countries in Africa can transition to net zero. And we've in some ways, we are led in South Africa by our government, which has also put just transition at the heart of its climate policy. There was a lot of attention to the Just Energy Transition Partnership, which was signed at last year's COP. But I think what we really are thinking about is, what are the pathways to more inclusive and sustainable growth in Africa that are decoupled from high levels of emissions? How do we decouple emissions from growth? And some of the things that we need to really look about is transition finance. We have, as a group, said that gas is going to be a big part of Africa's transition, and that's controversial. And that means in the next 10 years, we are going to see our exposure to gas increase before it comes rapidly down. We need to look at, where do we raise the finance for transition if we're not able to develop and sell our sort of hydrocarbons into international markets. Nigeria estimates that it's going to cost $420 billion for it to transition to net zero by 2060. South Africa is estimated it's going to cost $250 billion. How do we raise this finance and do this? And then I think we need to look at what Jose said about carbon markets. You know, Africa is a carbon sink for the world. The equatorial forests in the Democratic Republic of the Congo absorb more carbon than Africa emits as a continent. How do we start to put an economic value on that? How do we build carbon markets and carbon trading that has integrity, and so that Africa can play a role in sort of providing this opportunity to offset emissions and really start to think about that as part of what it means, what just transition means for Africa?
You raise so many good questions. You know, the just transition, it's not just an emerging market question, expresses itself differently everywhere, but the global debt problems and inflation problems that Jose mentioned, that exacerbates all of that. the role of carbon markets, how do we build those with integrity? And the whole transition finance question, are we going to get browner before we get greener in order to enable these high emission sectors to make their own transitions? And so luckily, Amit can answer all of these questions. And, Amit, if you look at these really challenging circumstances, financial markets, international coordination tough, this energy security focus, how is this affecting the global sustainable finance agenda? And do we risk slower progress because of it?
Well, thank you, Sonia, and I hope to be able to answer the question adequately. I think following my own chairman and then Nick and Wendy, I think a lot of the points that I wanted to make have been made, but I'll try and tease out some of the key themes that I see emerging from Standard Chartered's perspective and see if I can put them in some context with some examples as well. I think it is a difficult moment at the moment right now for the world when it comes to the energy transition. When we think about energy security and energy independence, we've started seeing rumblings of this, I think, during COVID, and obviously since the invasion as well of Ukraine. I think there's been an acute focus on every country's own individual energy security and independence. And I have been thinking about this question for some time. I've been asked it actually on a number of occasions. Do I think that the agenda will go backwards? I'm going to channel the chairman for a moment. I am an optimist generally, and I feel that we will ultimately, as a species, as humanity, we will get to the right answer. But we are going to see a slowdown. I think we are going to see some difficult trade-offs and choices that are going to have to be made. Wendy talked about the economy the continent remaining dark, and some of the challenges with gas as a transition fuel and hydrocarbons more generally. But at the same time, we're seeing European countries, as we approach the Northern Hemisphere winter, restarting coal-fired power plants. So, we've got this real dislocation going on where people are prioritizing energy security, energy independence over those climate goals. I do genuinely believe this is a short-term blip. I mean, that's my optimism coming through. I think one of the key sort of pieces of impetus that we're seeing as a result of the invasion is this increased focus. Well, we can't carry on like this. We can't be so dependent on hydrocarbons from other parts of the world. Let's create our own clean, green, renewable sources of energy in country. And I think, what we should hope to see is a huge acceleration of that. But again, my chairman stole the punchline. There is a dearth of bankability in bankable projects that we are seeing. We see a loss of capital that is committing itself through various platforms and coalitions such as GFANZ and all the various umbrella organizations that have mushroomed out there. Everybody wants to be seen to be allocating capital towards, sustainable projects, climate mitigation, climate adaptation. But we're not seeing the capital actually move across. And, Jose highlighted some of the reasons or some of the challenges that he would like to see emerging markets address. But I think it's also incumbent on those in developed markets who are the stewards of that capital to think about what they can do to make these projects bankable. Projects are not going to fall from the sky and all of a sudden, trigger or meet all of the requirements that are required. So I do think there's an evolution in the way we think about going about allocating capital that is absolutely going to be required. And you mentioned transition finance, as did Wendy a moment ago as well. I think that is ultimately we need to see significant capital flows into transition finance. And what do we mean by that? I mean, we obviously got the Just Transition paper, which again, I agree, it's an excellent piece of work produced by the LSE and Nick, and we're very happy that we could help contribute to that as well. But we really need to see the capital move. I think some frameworks, as we've seen, being published in the last few days by GFANZ and others, that really set out, well, okay, let's demystify what we mean by transition finance and really make it clear to people, well, look, we're not exposing you to greenwashing. We're not potentially creating reputational issues further down the line. This is what we mean by transition finance, and this is how we should be allocating capital. So I do think I am, as I said, optimistic about how we get to, but I am also a realist, and I think that in the very immediate term, we're going to probably see a bit of a stalling in this space.
It's something that we hear quite a bit, right? Especially as the international regulatory framework around climate finance and transition finance develops. There may well come a time when we need to be browner first before we can get greener. in order to enable this transition. But Nick, you know, we've been talking about these questions around mobilizing capital and so on, but maybe let's take one of the elephants in the room and hit it squarely. You know, the dangerous combination. You've been talking about this for many years. You've got high debt levels, climate and broader ESG vulnerabilities all mixed together in emerging markets, and now these are much more evident with global rates rising. So what can investors do to help?
So we have a really terrifying situation at the moment, don't we? And these converging crises. And I think one of the things that we have on our side is actually, I don't think any of the major players now disagreeing or against the shift to net zero. So that is the challenge we have. And I think, as Amit was saying, we've got to get really quite practical about how this shift to net zero and a resilient economy as well fits with the sort of real situation on the ground. And particularly, we know that markets really have not been properly pricing climate risk. They've not been properly pricing other forms of environmental risk. And the challenge is, as markets start to price that, whether that's the physical risk of countries to increasing extreme weather events, or indeed the risks of stranding of assets as we move to a low carbon economy, then actually you could see capital moving out of emerging countries, just as we need to actually expand it quite substantially. So I hear sometimes investors saying, well, if you wanted to simplistically get to net zero, you would sell your shares on the Johannesburg Stock Exchange and buy NASDAQ. Maybe that wouldn't be such a good trade now, given what's happened on NASDAQ. But you can see what I mean, that actually people could be actually drawing capital out of emerging markets, particularly with the interest rate rises, particularly in the developed countries. So we've got to think about how to overcome that. That does mean thinking carefully about the different roles of public and private finance, and then building on these platforms that are starting to develop. Wendy also talked about this Just Energy Transition Partnership that's going to be discussed a lot at COP27, to really see how the details of that are going to come through, and then seeing how that sort of platform can be extended to the likes of Indonesia, India, Vietnam, Senegal, and others. And I would like to sort of think that we could also be thinking really also about just nature partnerships, particularly because of the dependence of developing and emerging economies on the agricultural sector, the need to end deforestation, and the vulnerability to extreme events. I think here we might want to sort of mention some good news: the election of President Lula da Silva in Brazil, and his commitment really to take sort of serious action on reducing deforestation there. And perhaps on that note, maybe to sort of pause really, is clearly we're going to need bountiful projects at the asset level, the transaction level, and so on. But one of the areas which I think is a really important point of engagement, particularly from institutional investors globally, is the sovereign debt markets. We've already seen quite a lot of engagement from investors with the Brazilian authorities, notably with the Brazilian Central Bank, indicating a really long-term desire to invest strategically in Brazil for all the obvious reasons, but signaling their real concern about deforestation rates, their concern about human rights and indigenous people's rights. And I think, therefore, as that new administration comes in under President Lula da Silva, I think there'll be quite a lot of supportive noises from institutional investors to see how that sort of long-term growth strategy from Brazil can be linked with deforestation. And here, sovereign bond structures can help. We've already seen some sustainability-linked sovereign bonds in Latin America from Chile. We, with the Planet Tracker Initiative, have highlighted potentially you could have a sustainability-linked bond in Brazil, for example, linked to deforestation rates. So as the country such as Brazil hits its deforestation targets, its cost of capital for its sovereign debt would be capped or reduced. So I think that the sovereign market, as well as maybe the sort of the corporate and project finance, is also an area we need to be thinking about.
It is good to be thinking about practical solutions, as you say. I mean, we've been talking about voluntary carbon markets, the role that they can play. There's a new sustainability-linked sovereign debt hub housed at the World Bank. There's a lot of work on climate resilient debt instruments. So there's lots of potential to tap this gigantic pool of global debt for good, to address these issues. But Wendy, maybe we can turn to you here and tell us a little bit about how you work with clients in sectors that are most affected by the need for transition, the ones that are most at risk of displacement and so on. How can a private financial sector firm like Standard Bank make a difference?
What we've realized is we have to, and we have started engaging with those clients. So we have to get into conversations with them about their transition plans and to talk to them about climate risk and also opportunities that may arise around banking and funding and supporting transitions in their where they operate. The real economy is where the transition has to happen. And I know this is something the Net Zero Banking Alliance is looking at. How do we bring associations of real economy firms into these discussions with financial institutions so we can move this forward? And some of the things that we've been doing, for example, is talking to our clients in South Africa who are facing the carbon tax. So in South Africa, we have a carbon tax, and it's a main policy instrument used by the government to achieve our carbon commitments. It's being ratcheted up quite significantly. So this is driving a demand for carbon offsets and potentially the opportunity to be a market maker in carbon offsets and bringing in integrity to that. We also have just held our second climate conference for clients. Sonia, you addressed the conference, but it's starting to bring clients together to talk about and better understand the risks that they're facing and their need to adapt and transition, and so that we can go into conversations with them about the role we can play in supporting them. And that also means you've got to bring your frontline bankers, your transaction teams, your deal makers, your coverage teams into these conversations. Your oil and gas sector heads, your mining sector heads have got to be on top of the issues, the debates and so on, so that they can have these engagements. It can't be something that's only happening in the sustainability team or the risk team. It's got to be throughout the banks. And I think just a final point is, I think the big challenge is actually going to be with more small and medium-sized firms. They drive our economies, and it's easier to have these conversations with other corporates that are big, that have the resources, the capability to get to grips with climate change and climate risk. But we've got to, I think, get a little bit more creative about our role in supporting small and medium sized firms in this transition journey.
Well, and to your earlier point about it not being just a consideration for emerging markets, I mean, SMEs drive the bulk of the economy, around the world, and it's just very different for them with fewer resources wherever you speak. And thanks also for mentioning the voluntary carbon markets sort of development. The Integrity Council for the Voluntary Carbon Markets has come out with a set of core carbon principles. We just finished a big consultation there, so that should help with maintaining a benchmark, creating standards for this market. So, but Amit, let me come back to you here. Standard Chartered has been so active for so long in investing and lending to emerging markets around the world. And, as we've been discussing, they're very reliant on fossil fuels and lots of challenges in just transition. So when you think about your net zero planning, and that's what we're all focused on at the moment, how do you integrate all of this?
Yeah, it's really challenging. It's really challenging, but I'll give you some. So I'll sort of lift the bonnet in a second as to how we're approaching this. But we as an organisation achieved net zero in February 2021, and in October 2021 is when we came back to the market, setting out our roadmap, and we started with 3 of the most high carbon sectors in our portfolio, and that was oil and gas, mining and metals, and power generation. And we set targets which we believe are science-based targets to achieve net zero, so interim targets for 2030. As part of that, we also set out a requirement that all clients in those sectors by the end of 2022 must have a transition plan in order to continue to be clients of Standard Chartered. So, that was a pretty tall order of request when we think about, the breadth of Standard Chartered's portfolio across the globe. And a lot of the comments that Wendy made about the client bases that we have in certain markets just not necessarily engaging in the same level with this agenda as other corporates. But we nonetheless made that commitment, and we have been monitoring, following up and tracking on that ever since we have done that. And the majority of our client base would have been contacted. We've had those conversations about their transition plans and what it is that they are doing to achieve net zero. But we are approaching this on a portfolio basis. So our targets are very portfolio based, and although we have monitoring clients individually, we do recognize and we actually support a differential approach between different markets as well. So some of our clients who are state-owned enterprises in markets where there is a 2060 commitment to achieve net zero or a 2070 commitment to achieve net zero are not going to move faster than that. So while we may have a 2050 target, what we are going to be looking for is some clients meeting that earlier, and obviously, relying on other markets to maybe catch up at a different time. That voluntary carbon markets will play a huge part of the tail end of that process. But as we go through our portfolio reviews and our individual client transactions, the SME portfolio is definitely one that is in a slightly different place, and that's not just in sort of emerging markets, but as you said, Sonia, also in developed markets as well. We are seeing that there is a big discrepancy in where clients are from their transition plans. But I sort of come back to the point I was making. I remain optimistic, and one of the interesting pieces of work that we have done over the last couple of years, actually before we'd even made our net zero commitments, because we're a UK regulated bank, our main regulator, the Bank of England, is sort of Mark Carney's parting gift as he left the Bank of England, was to impose on UK banks the requirement to implement climate risk considerations into our BAU credit decision making process. And so we've created a whole infrastructure that supports this. And I'll give you some statistics. In 2021, we reviewed about over 2,000 clients' climate risk profile and what impact that might have on their credit profile. And by the end of this year, we're on track to achieve close to 3,500 clients from a climate risk perspective. And that includes their physical risk, their transition risk. What do they do from a transition risk mitigation perspective? So we have some head start, if you like, at looking at the individual transition plans of our individual clients in these markets. But I come back to how we approach this. It's a portfolio approach. We can't say it's one target for every single country and every single client that we have. We have to be a bit more nuanced about it. And we're comfortable with that, allowing people to move at a different pace. And I think that plays in very naturally to the conversation around just transition. There has to be an acceptance that different markets and countries will move in different trajectories.
No, really interesting. And as you say, we so often focus on the challenges and risks, all of this transition planning, this climate risk assessment, that's, no one said this was going to be easy. But Nick, I was really struck by something you'd said the other day. If we get this right, the business opportunities in banking and investment are absolutely massive. And so how should financial firms be thinking about capitalizing on these opportunities to get the scale that we're after?
I think we're really at a pivot point. I think we're moving into the next phase of climate finance. At COP, there'll be a really important report released by Dr. Vera Songwei, who's Executive Director of the Economic Commission for Africa, and Nick Stern, who leads the Grantham Institute where I work. And that'll be sort of setting out the sort of new framework for climate finance, dealing very much with the architecture that we've discussed from sort of IMF downwards, but also thinking about the private finance area. And so I think we because of the commitment we have, we're going to think the next few years is going to be quite a step change, I think, in terms of the speed of delivery that we need, 8 times perhaps annual climate investment in emerging countries. I think we're hitting some sort of pivot points. Some analysts are saying, and I think they might be right, that we're hitting sort of peak fossil fuels. We may already have peaked, but certainly IEA is saying this is the decade when we're going to be peaking fossil fuels. portfolios, that leads to very different dynamics in terms of energy markets. One thing we haven't touched on yet, but for many banks, housing, mortgage markets are often the biggest part of their portfolios. It's really hard, and we can talk about the challenges there, but actually finding ways in which both new build and retrofit can be brought up to standards, helping customers save money in the process, obviously with very high energy costs. I'd just like to pick up the points we talked, both Amit and Wendy have talked about in terms of SMEs, and thinking through how that challenge and opportunity can be addressed, both through maybe corporate supply chain, but also in a very place-based way. And here I think sort of partnerships between banks and community finance development institutions is going to be really important to actually ensure that SMEs receive the access to capital. And then maybe just a final point in talking about just transition, that obviously we're thinking about dealing with social risks, the opportunities. But again, I think there's an opportunity for banks to sort of reconnect with the broader society through this process of dialogue and participation, which is absolutely core to just transition. One trade unions told me that really for them, it means sort of nothing about us without us. And I think, again, banks and their role in society can really reach out, I think, in terms of dialogue and involve people in their plans.
Well, that's a really good point. Also echoes some of the comments that Jose had made earlier around the blended finance front, this whole concept of partnership and dialogue. And Wendy, you co-chair the board of UNIP FI, and you're very active in lots of international forums like the Principles for Responsible Investment. So, how do you work in these groups, and how are these groups looking at the linkages between things like climate and natural capital and just transition and so on?
What's really interesting is that this concept of the intersectionality, the interconnectedness of issues around climate change has really sort of accelerated up the agenda in this year. So in the past, we may have looked at issues like climate change, pollution, human rights, economic inclusion in silos through different lenses, but actually on the ground, these things are all interlinked inextricably. You can't tease them out. And I think what's happening is as well, and this is part of what a just transition means, is about bringing the E and the S of ESG together, and looking at them together and how they play off each other and what they mean for each other. So as part of the Principles for Responsible Banking, which now has 300 signatories in 80 different countries around the world, and is about 50% of global banking assets, is because we've got banks, big banks, small banks, global banks, very small local regional banks, credit unions, universal banks. We've had to think about how do we develop frameworks that make sense and are flexible enough to accommodate the big players, the vanguard in these developments, as well as those just starting out on this journey with different regional nuances and so on. And because of that, I think it's forced us to bring these issues together in a more connected way. To think about, if you think about renewable energy, it needs particular kinds of minerals that are often mined in areas subject to a lot of conflict. There's child labor issues and so on. So just because it's clean doesn't mean there aren't human rights issues or social risk issues, and we need to bring them together. But I think the key challenge, and something that we're very aware of as the banking board, is these different approaches need to integrate. We can't just keep adding frameworks and adding toolkits and adding expectations and requirements onto banks. We've got to bring them together in a more integrated and holistic way. Otherwise, we are going to drown in the reporting requirements and lose sight of what we're trying to do, which is actually have a positive impact.
Well, I can only say here, because I think the proliferation of international frameworks and initiatives is a challenge for us all, not least the reporting element of it. But that's a whole nother discussion we need to have. But Amit, maybe you could say a few words about Standard Chartered's international partnerships and your relationships in supporting just transition. You mentioned the MDBs, blended finance. Maybe give some sort of practical examples of how you're taking this forward and where the opportunities are.
Yeah, sure. I just want to echo Wendy's comment though about all of the plethora of acronyms that we could throw out there right now, and how they all need to interrelate. But a lot of have been mentioned. We participate on a number of international platforms, and we do that to make sure that Standard Chartered has good positioning, but then also to make sure that we can take best practice and try and apply that in those 59 markets around the world that we're actually operating in. I think a very practical business that we pursue quite aggressively is our export credit agency financing. A lot of the investment into infrastructure into Africa is ECA backed, and so we are one of the few commercial banks left, international commercial banks left in Africa. We obviously work closely with Wendy's colleagues on transactions on the continent as well. But we do spend a lot of time nurturing and developing that, because a lot of that is going directly into infrastructure development in Africa. It's a form of blended finance. It's not necessarily the most traditional form of blended finance, but it's something that we pursue that through obviously our ECA desk, but we also spend a lot of time working with the IFC, the Asian Development Bank, the African Development Bank, really to understand what the investment priorities are for them and how we can support them, because we are quite open for taking risk in emerging markets. You mentioned it earlier, Sonia. We've been in these markets for many years. They're our home markets. So I guess that's probably the simplest way, or the most practical way, that we continue to try and do this. And then just making sure that we are fully plugged into the governments of these countries as well, and really understanding what their priorities are and how we can support them in generating the capital. We often describe Standard Chartered as a bridge. I sit in London, Jose sits in London, a few floors up from me today, and we spend a lot of time with our European investors, our North American investors and clients, saying, look, let's how can we help you take that capital into emerging markets? So it's sort of a really key focus area for us.
Nick, maybe we can end with a bit of a lightning round here on what hopes and dreams from COP. What are some of the key things you'd like to see as outcomes this year?
I mean, obviously the backdrop is a very tough one, but I think we will see progress. As I mentioned, I think we're going to see some new frameworks coming out in terms of sort of the strategic framework on climate finance, the Songway and Stern review, so look out for that. I think there's going to be a lot of focus on sort of specific mechanisms around just transition, so look out for those. And I think, again, moving maybe perhaps beyond just the energy transition, thinking about nature as well, and agriculture and those sectors. So I think, again, although it's a tough backdrop, I think we are going to see sort of material steps forward. And again, it's sort of one of two in the Middle East region. So I think the focus on Middle East and Africa is going to come through very strongly.
That's really interesting, isn't it? Because you have 3 emerging market COPs in a row coming up. So that's really, really quite something. And Wendy, what about you? Your expectations from COP? Every year now, it's a lot of COPs, right? Going for every 5 years.
Yes. Really, standard banks getting involved more in COP this year, really to advocate for a just energy transition for Africa, and to use this opportunity to talk to our clients and other stakeholders about what that means, and just to show that, we're ready to play our part in that, and really want to bring that front and center.
Amit, any last words?
I agree with Wendy. I think I want to see a lot more focus on adaptation finance. I think, we spend a lot of the industry is focusing on mitigation. It's understandable. I think adaptation, and coming back to blended finance, I think that's where we're going to have to see a lot more blended finance to really drive the adaptation, because even at 1.1, 1.5, we're seeing the impact already. So, I think really focusing in on that is going to be crucial. And I want to see more around that come out of this COP in particular.
Well, wonderful. It brings us to the end of our discussion. I want to thank you all, Nick, Wendy, Amit, for a terrific set of insights. We really appreciate it. I look forward to seeing you all in Sharm, and for everyone else, we've got lots of COP talks coming up, so please stay tuned and check out our website. We'll bring it all to the world. Thanks very much, and enjoy your day. Thank you.